When analyzing market structure, we typically use the highs and lows on the chart to define the range. But in candle range theory, the idea is that every individual candle actually holds its own range. And this makes sense, because when we look at this daily candle on the 1-hour time frame, we can see that the daily candle's wicks represent the 1-hour swing low and swing high, which in itself forms its own isolated range. And whilst this might seem like basic knowledge in market analysis, when we incorporate smart money concepts, this one candle setup can actually offer us consistent high probability trades. So in this video, we've broken down everything that you need to know about candle range theory into 5 simple steps. So let's waste no time and start with step number 1, which is how we can use candle range theory to identify trade setups. The typical framework for this strategy usually involves 3 candles, and each candle has its own important role. So let's start with the first candle. Here we have a bullish candle on the daily time frame, and we can visualize this candle's price data with higher and higher accuracy the lower down we go in time frames. But for this strategy, all of the price action data we need from all of these candles can still be found in the daily candle, and this comes down to the basic information that it tells us, which is that during this specific day, the market opened at this price and ended up closing at this price, with the highest and lowest prices found in the wicks. Now when it comes to candle range theory, the belief is that both the top and bottom wicks act as their own isolated liquidity levels that the following candles will use as targets. And this makes sense, because if you take a look at any random chart, you'll see that almost every individual candle will have attacked either the previous candle's high or its low. So in terms of candle range theory, the first candle is simply used to define a range that we are interested in trading, and the upper liquidity level is called the candle range high, and the lower liquidity level is called the candle range low. And if you're wondering which candle can be used to define a tradable range, we can actually use any candle that you might find on a chart, and this can also be on any time frame. But there is of course criteria that helps us define what makes a candle ideal to use, which we will be covering later into the video. And then for the second candle, this plays the most important part in whether we actually have a setup or not. And the reason being is that the whole concept behind candle range theory is that if the price attacks the candle range high but fails to close above it, there's a high probability that the next target will become the candle range low. So to walk through what this looks like, we want to see the second candle push up and above the candle range high of the first candle, before then pulling back into the range, where it will then close. And it's crucial that we see this liquidity sweep occur, because if we were to instead see this second candle close above the candle range high, the potential CRT setup is no longer valid, as it's more likely that the market will continue pushing up, instead of targeting our first candle's range low. So if the criteria is met for the second candle, we can then look within the third candle for a setup that we can use to take a short entry, with our target being the candle range low. You can of course hold your trade for longer if the external market